Welcome to the SmartKeys podcast. Today, we are doing a deep dive into what is, I think, the fastest and most critical shift in retail finance we've seen in years. Buy now, pay later, or BNPL.
It's so much more than just a consumer trend, isn't it? It's really become a strategic lever, a
Ugh.
tool for efficiency and sales that, frankly, professionals in retail and finance,
Mm-hmm.
they just have to understand it right now.
Absolutely. Ignoring it feels like you'd be risking a real competitive disadvantage, especially heading into the 2025 and 2026 landscape.
You really would.
So we've pulled together a stack of sources focusing on some great strategic insights from smartkeys.org to break this all down. We're looking at the mechanics, the payoff, and of course the sometimes hidden costs for merchants.
Right, the actionable knowledge you actually need.
Exactly.
So maybe we should start with a quick definition, because the core mechanism is what really drives the benefit for the merchant.
Good idea.
BNPL, at its heart, allows a customer to split a purchase into manageable, interest-free installments.
Usually 4 payments over, what, 6 to 8 weeks?
That's the most common model, yeah. But the critical part for the retailer is that they don't have to wait for those payments. The BNPL provider settles the full amount right away, minus their service fee.
And that transfer of risk plus the immediate cash, that's the game changer. But the scale of this whole shift, that's what really sets the stage for me.
It does. The source material we looked at highlights some pretty explosive growth. Get this, over 15% of Americans use BNPL in 2024.
Wow.
And if you look globally, the total transaction volume, it topped $309 billion in 2023.
309 billion. So this isn't some niche thing anymore. It's a core feature of modern shopping.
It's completely integrated. And that kind of scale suggests it must be driving some serious revenue gains.
Right. And here's where it gets really interesting. Let's dive into those measurable returns merchants are seeing, because they are. They're massive. We're not talking about small tweaks.
No, not at all. The data is highly persuasive. Retailers who get the integration right are seeing immediate gains in conversion. I mean, we're seeing market estimates that put conversion lifts routinely between 20 and 30%.
And what's really striking is that it's not just conversion. It's coupled with much higher ticket sizes. Affirm, for example, they report something like a 20% conversion increase and an 87% jump in average order value.
87%.
An 87% jump in AOV. And Stripe, another big player, they cited a 27% uplift in total sales volume.
And that combination, getting more people to buy and getting them to spend more when they do.
That's the holy grail for a merchant, isn't it?
It absolutely is.
But hold on, isn't it just credit with a different name? Why does BNPL unlock sales where a credit card might make a shopper pause?
That's the core psychological breakthrough of this whole model. See, when a consumer sees one big price tag, they feel the full cane of that cost immediately. But by splitting it into 4 equal, predictable, and, this is crucial, explicitly interest-free payments, you trigger a different kind of mental accounting.
You're making the big purchase feel smaller, modular.
Precisely. The shopper focuses on that first manageable payment amount, and it just dramatically reduces the what they call the pain of paying. So they're more likely to trade up to the premium version or add those impulse items to the cart.
So the provider isn't just a payment gateway, they're a psychological marketing tool, which makes sense on the sales front. But the operational advantages for the merchant, those are just as compelling.
They absolutely are. For the retailer, you gain so much efficiency, the provider shoulders all the financial complexity.
Okay, what does that mean in practice?
They handle the instant credit approval, all the payment collection from the consumer, and most importantly, the default risk. The merchant is completely insulated if a customer fails to pay.
And as you mentioned earlier, that cash flow benefit is immediate.
Immediate liquidity is key. Since the provider pays you up front, your capital isn't tied up. You get cash right away. So you can restock, fulfill orders, and you don't have to strain your working capital.
Plus, this opens up whole new pools of customers, right? People who maybe avoid or don't even qualify for traditional credit cards.
That is a huge strategic advantage. The data clearly shows that millennials and Gen Z are leading the adoption. If your products appeal to younger shoppers, this isn't optional anymore. It's basically mandatory to meet them where they prefer to pay.
Okay, let's unpack this. That's a powerful argument for adoption. But this kind of game, it obviously doesn't come for free. If the conversion lifts are 20 to 30%, what are the trade-offs we need to be modeling?
The primary one is the cost, the merchant fee. And this is where you really need to pay close attention.
So compared to a normal card transaction, how much higher are we talking?
Well, standard debit and credit card fees, they usually run between, say, 1 to 3%. BNPL fees, however, can range from about 1.5% all the way up to 7% per transaction.
7%. Wow. So if your margins are already tight, that can compress profitability very, very quickly.
Right. If you haven't engineered enough of a lift in sales or order value to cover that higher cost, it's a problem.
So you have to make sure the AOV jump is big enough just to break even on the fee alone? What about on the operational side? You mentioned complexity.
Yes, operational friction tends to show up in two areas: returns and customer service. Returns are a major one because the same psychology that encourages spending can also fuel more impulse buys.
Which naturally leads to higher return volumes.
Exactly. And the cost of those returns is rarely factored in properly. Our source material notes that processing a return logistics, inspection, restocking it, can average about 66% of the product's original price.
So if you get a 30% conversion lift, but your return rate also jumps significantly, you could actually be losing money.
You could be on a profitability treadmill and not even know it.
And what about customer service? When a customer has an issue with their payment plan, who do they call?
Almost always the merchant. That's their first instinct. Even though the BNPL provider handles the actual collections, the customer contacts the retailer where they bought the item.
Which creates a lot of service overhead.
A ton. You have to invest in training your staff, creating playbooks for how to handle these third-party payment questions, disputes, refunds.
And I imagine there's a technical overhead too.
Yes, this isn't just a simple button you add to your site. It requires sandbox testing, accreditation, new accounting workflows. It takes real resources.
So this all brings up the big strategic question: how do we apply this knowledge efficiently? If it's a lever, where's the best place to pull it?
It really comes down to finding the sweet spot for your average order value. You don't want to offer BNPL on a $20 item where a 7% fee just kills your margin. You want to use it where the upfront cost is a real point of friction for the consumer.
So is there an industry consensus on what that sweet spot is?
The guidance right now seems to point to a range of roughly $50 to $500.
Okay, 50 to 500.
Yeah. Below $50, the fee eats too much profit. And above $500, the repayment term usually gets longer, which increases the provider's risk, and that means more declines for your customers.
So the mandate is clear. This is not a site-wide set it and forget it tool, which brings us back to what you have to do as a professional listener: the break-even mandate.
Absolutely. You can't just look at top-line revenue. You have to run a proper, data-driven break-even model. You weigh the conversion lift at 20 to 30%, and the AOV gains against the higher fees, and that potential 66% cost on returns.
Can you walk us through a quick example?
Sure. Imagine your normal profit margin is 10%. If your BNPL fee is 5%, you've already lost half your margin. Just gone. To get that back, you need a conversion lift of about 25% just to break even, assuming everything else stays flat. The uplift has to be significant.
But if your AOV also jumps 50%,
then the equation shifts dramatically in your favor. But you have to run those scenarios for your specific products.
so the smart first step is to minimize risk while you collect that data.
It is, which is why the professional mandate here is to pilot first, start small, run a time box trial on specific products or categories that are right in that $50 to $500 sweet spot. Track everything: return rates, customer satisfaction, support tickets.
And since not all providers are the same, Klarna, Afterpay, a firm evaluating the partner is a huge part of that pilot, right?
Crucial. You have to compare their fee tiers, their approval rates for your audience, their integration. Is it a simple plug-in or costly custom work? And pay really close attention to their data and reporting. You need a partner that gives you clean data so you can actually figure out what's going on.
If we connect this to the bigger picture, BNPL is essentially installment lending. And anytime a financial product gets this big, regulators start paying attention.
That's the connective tissue. And regulatory momentum, especially in the U.S., is picking up fast. There was a really significant development from the CFPB, the Consumer Financial Protection Bureau, back in May of 2024.
And what was the big implication of that decision?
The Bureau essentially ruled that large BNPL lenders should be treated like credit card providers. This means they're going to fall under the umbrella of the Truth in Lending Act, or TILA, and Regulation Z.
Which is a huge deal for consumer protections.
A huge deal. We're talking about required periodic statements, standardized billing, and most importantly, clear procedures for handling disputes and errors.
So the operational complexity we talked about earlier, it's about to get even tighter for merchants.
Absolutely. You should expect new compliance rules around refunds and billing. Your finance and accounting teams are going to need updated workflows. And you'll have to update all of your on-site language, your post-purchase emails, your support scripts. Everything has to align with these new consumer rights.
This makes your choice of provider not just a financial decision, but a regulatory risk decision.
Precisely. You have to prioritize partners who have strong compliance frameworks. Otherwise, the cost of managing that risk could easily wipe out any sales gains you see.
So what does this all mean? The core insight, it seems, is that BNPL is a measured tool. It's for nudging specific sales, not some magic bullet for growth.
That's the strategic takeaway. The conversion lifts are real, the AOV often rises, but you have to treat it as one specific lever in your overall strategy. You test, you measure, and you iterate.
So the key isn't if you use BNPL, but how you implement it. You need a focused pilot, a clear understanding of that $50 to $500 sweet spot, and you have to pick a partner that helps you meet these evolving compliance standards. The goal is to make sure the gains truly outweigh all this new complexity.
That data-driven approach is what separates a successful strategy from a very costly tactical error.
And that is the essential knowledge professionals need today. Thank you for tuning in to the SmartKeys podcast for this deep dive into buy now, pay later.
We really hope these insights help you build out your own break-even models and select the right partner for a pilot program.
For more actionable insights and to read the full article we discussed today, just check the show notes. We've put the link to the full smartkeys.org piece right there. And please subscribe now so you don't miss our next deep dive.
Goodbye for now.
See you next time.